Wonder why they call you bitch.
Welcome to Insights. I'm Eric. I hope everyone had a good holiday weekend. We're going to return here by talking about the labor report that was put out on Friday and pretty much went under the radar screen of commentary. Mainstream media, if it was focused on it, would have probably um, had nothing but a round of applause for the numbers. There would have been cheering, there would have been everything, and it would have been highly political. Everything's political now, so I've watched these numbers long enough to know how to read through them in order to quickly dispense of the political spin that takes place. People call it fake news now today, but propaganda and spin for economic numbers has been around a long time. As long as I've been watching this stuff, I've been seeing it. The job recovery was a big number on the headline. I think it was over 900 jobs created from month-to-month change, but that came at an expense, of course, of a huge job loss during the lockdown period. But this chart here is going to talk about the breakdown, and we're going to see the trends that are quite obvious. The service producing trend in the U.S. from 45 or after the World War II has grown in importance and significance dramatically. It used to represent about 60% of the economy. Now it's near 90. Here's the public sector or private sector non parts private job creation relative to the overall labor numbers or labor force, and it's roughly about 85%. The real hit comes in the goods producing or the manufacturing side here, which is these two numbers right here. After World War II, they were about 40%. Now they've fallen pretty close to single digits, and there lies the trend that explains the transition away from a goods producing nation to a service producing nation. It's what Greenspan at one point tried to convince everyone that it was a stable transition. It would be good for the U.S. It really didn't matter what his opinion was, or even my opinion today. Good, bad, it's what the U.S. is. The U.S. is a service-producing nation. The manufacturing sector has moved overseas. It exists to some degree here in the United States, but it's a minor part of the overall economy at this stage of the game. Service producing sector limits a nation's ability to trade with others. It's difficult to trade your services for physical goods, and that's why we have such large deficits, because nobody can really get the services other than some biotechnology technology and some technology that we still create in agricultural and farm products, which are tradable on a national level or a global level. Services, whether it be hospitality, uh, healthcare, things of that nature, they call burger flipping type of jobs. Those are not really tradable. It's low skill, low wage. Can easily be acquired by other nations or easily adapted when those particular institutions open up in their local economy. So this is one of the reasons why wages haven't risen too much. It's coupled with the fact that the high taxation here in the Western economies. It's really responsible for why the middle class has been gutted in general. Standard of livings have dropped dramatically. One income cannot maintain a household. It usually takes two now, and even then you can't get by because the cost of everything is far exceeds the wages of a service producing nation. So when you take a look at the headlines or social media and everyone's clapping about how strong the economy is, keep this in mind. This is a service producing nation that is going to have declining standard of living. Probably, and that's one of the reasons why there's going to be so many stimuluses. Anytime there's a hiccup, they're going to toss out money to everybody when they can get a chance because it's a vulnerable. There's vulnerability here. They're low paying. There's not a lot of savings in this country. It's not whether I think it's right or wrong. These are just the trends. I mean, you can't argue with the trends. You can argue with who's managing and why we're doing this and whether or not this is even controllable. There's a concept called the invisible hand, and the invisible hand moves around based on the intentions of all self-interest of all people on the planet. And there's a reason why it's doing this stuff, but there's some ways you can shift things out. But the U.S. and Western nations are probably not going to choose that until things crumble and break. From a standpoint of is everything okay, I think we have to take a look at the civilian labor force to answer those questions. Here's the civilian labor force. Right now, we have 160 million people working in it. We have roughly at the high watermark was 165 million. At the low watermark, about 156. There was a sharp decline during the lockdown, during the pandemic. We're recovering. Everyone's so excited about it. It's sending stock prices higher. It's got everyone convinced we're going to build back better and it's going to be better than ever, but we have a lot of work to do and we're probably going to run out of time due to our complete utter reliance on debt. And eventually, when taxation slips up and slows this recovery, which is inevitable, that debt burden will probably keel over and people not and debt doesn't cause the social unrest. It's actually just the loss of confidence that causes that. But those it is going to be the trigger mechanism. If we look at the civilian labor force in closer detail, we can see in 2019 the high of 164 million and 500,000 roughly jobs, or not jobs, but people, civilians in the labor force. This crashed, we've recovered, and we can see by here, this if you mark this as the 0 point, as this is the high, we lost 8 million jobs or 8 million civilians out of the workforce at the low point or the nadir of the pandemic. The V-shaped recovery clearly is not causing a V-shape in the labor market. Civilian labor force has recovered only about half of what it's lost, roughly, which, considering the equity markets are breaching and pushing all-time highs and well above, you'd think that it would be a winner takes all. But Main Street, which is a part of the labor force and is working in the service producing economy that has been created here in the U.S., they are not benefiting because 4 million people still remain out of the labor force, probably collecting some sort of compensation or completely given up. I mean, I don't, and we're not, that's not what this chart is looking at, but this is not a V. This is a waterfall decline and grinding sideways as we attempt to recover that jobs loss in a service producing economy. Give it enough time, it probably will do that. Time is going to be the important variable here. I don't think we're going to be allowed to wait until 2025 or 2020 or 2030. Eventually, there's going to be a break of confidence along the way, probably induced by taxation on a very vulnerable economic background. The stock market is being driven higher by global capital flows, not by real world assessment of what's taking place in the Western economies, Main Street. It's a financially driven outcome, not entirely responsible by the Fed. The Fed really plays a part of setting the interest rates. The money is moving basically because the U.S. is the cleanest, dirtiest shirt in the hamper, as a description. The global economy is quite vulnerable, but the U.S. remains the strongest, weakest player, if you want to say it, and that is attracting capital flows from everywhere. It's buying the Dow Industrials, it's rotating, but ultimately that has nothing to do with the labor force situation. As this lags, as the financial assets continue to grind higher, this will lag, and we'll keep an eye on this, and we'll talk more about it in the future. Ultimately, it's going to put more pressure. Social unrest will develop as the haves continue to pile on their gains and the have-nots struggle just to get by. So the employment report, which on surface looked quite well, and I'm sure as you read the headlines will be spun into a miraculous recovery and in an effort to build back better or build back the world that we knew. We're a long way from it. So we're going to keep an eye on these trends. They're not really inside the matrix, and we're going to talk about them again. I encourage people to subscribe to the Matrix in order to follow similar trends like this. The economic activity composite is the real-time economic activity or a real-time economic measure flow, whether the economy is expanding or contracting. This is labor. Labor tends to lag a little bit, but if the economy continues to roll, we're going to improve these numbers to some degree. But if we start to lose economic activity on the margin, we're going to slip back down again. So I would subscribers, I would keep an eye on the economic activity composite going forward here and keep in mind what's the situation of the labor force, regardless of what you read in the headlines. So thanks for watching the video and enjoy the trading week.